the RMD trap that steals your Medicare savings. The hidden tax that catches every retiree. You've worked your whole life, saved what you could, and finally reached the point where you should be able to relax. But there's a catch that most retirees never see coming, one that quietly drains thousands of dollars a year without you realizing it. It's not a scam, it's not a mistake, and it's not optional. It's built right into the system. I call it the hidden tax of retirement. And if you don't plan for it, it can steal a shocking amount of your Medicare and Social Security savings. Here's what makes it so sneaky. At age 73, the IRS forces you to start taking something called a required minimum distribution, or RMD, from your tax-deferred accounts, things like traditional IRAs or 401ks. The idea is simple on paper. The government let you save that money tax-free for decades, and now they want their share. So each year, they require you to withdraw a percentage and pay income tax on it. Sounds fair, right? Except, once those withdrawals hit your income line, they start a domino effect that hits you in 3 painful ways, each one feeling like another hidden tax. The first tax is the obvious one. The RMD itself is treated as regular income. Even if you don't need the money, you still have to take it, and it can bump you into a higher tax bracket. Then comes the second layer, the part retirees almost never expect. Those extra dollars also push up something called your combined income, which is how the government calculates how much of your Social Security benefits get taxed. One year you're fine. The next, suddenly 85% of your benefits become taxable, all because of a forced withdrawal you didn't even want. And the final blow, Medicare. The higher your reported income, the more you pay every month for Medicare Part B and Part D. It's called the Income-Related Monthly Adjustment Amount, or IRMAA. Most people never hear the term until they see their premiums shoot up a few $100s a month. It doesn't sound like much on paper, $20, $30, maybe $50 extra. But over a year or two, that's money straight out of your pocket gone for good. And the increases can stack quickly the closer your income crawls to those IRMAA brackets. Put all 3 together. The regular tax on the RMD, the tax on your Social Security benefits, and the inflated Medicare premiums. And you've got a perfect financial trap disguised as a normal rule. It's not illegal, it's not shady, but it might be the single biggest silent spender eating into retiree budgets across the country. And the worst part is, it often happens automatically. You take your RMD because you have to, it gets reported to the IRS, and 2 years later the IRS sends that income data to Medicare. Suddenly, your premiums rise, not because you actually earn more, but because the system says you did. Now, why does this matter to you? Because this hidden triple tax can quietly erase the savings buffer you thought would cover your healthcare costs or extra spending in retirement. It can make your budget tighter, your taxes heavier, and your benefits smaller, all from an income increase you didn't choose. But once you understand how it works, you can fight back. That's exactly what we're going to do. Over the next few minutes, I'm going to break this down clearly piece by piece, so you can see how the mechanics work under the surface. You'll learn how RMDs are calculated, why they push your income up even when you don't need the money, and how each of those hidden taxes link together like gears in a clock. Then I'll show you what smart retirees are doing right now to minimize, offset, or even completely avoid these traps. Because while the rules are strict, there are perfectly legal strategies that can keep more of that hard-earned money in your pocket. By the end, you'll know how to identify your personal risk factors before your first RMD ever hits, the choices that can cushion the tax shock, and the timing tricks that can save thousands in Medicare costs. Let's pull this curtain back, because it's time to stop letting the system quietly siphon off your retirement income and start making those dollars work for you again. How the RMD trap works. So let's strip this thing down and look at exactly how the RMD trap actually works, because it can sound complicated until you see what's really happening underneath. The first thing to understand is simple. This isn't a penalty or a punishment. It's just the IRS calling in the tax bill you postponed for decades. Every dollar you put into your traditional IRA or 401k went in before taxes, which was the whole point back then. You saved on taxes today with the understanding that later, when you're retired and maybe in a lower bracket, you'd pay those taxes as you take the money out. Now, once you hit age 73, the government says, time's up, start withdrawing. That forced withdrawal is the required minimum distribution. You don't get to choose whether to take it. Even if you've got plenty of cash in savings or your pension covers your bills, you still have to take that RMD every single year. And yes, the IRS keeps track. If you skip it, they'll hit you with a 25% penalty on the amount you should have withdrawn. That's not a typo, 25%. If your RMD was $20,000, you'd owe a $5,000 penalty plus the taxes you would have owed anyway. It's one of the steepest penalties in the tax code, which tells you just how serious they are about collecting it. So, how much do they make you take? Each year, the IRS publishes something called the Uniform Lifetime Table, a very unromantic spreadsheet that lists your required withdrawal factor based on your age. It assumes a life expectancy to spread your balance out over your remaining years. The math's simple. You divide your account balance at the end of last year by the number from that table. At 73, the divisor is roughly 26.5, which means you have to take out about 3.8% of your account. Each year, that percentage creeps up. So by your mid-80s, it's closer to 7% or more. That means the withdrawals grow significantly as you age, even if your spending hasn't. Now, the key moment, the one most people don't realize, comes the second that withdrawal hits your bank account. It shows up as ordinary income, not capital gains, not special treatment, just straight income. It gets added to your adjusted gross income, or AGI. And that's the number that controls everything else on your tax and Medicare radar. Basically, the government doesn't see an RMD, they see a bigger paycheck. Here's what that looks like in real life. Let's say you're 73, your IRAs total $600,000, and this year your RMD is around $23,000. Maybe you also get $30,000 a year from Social Security and another $15,000 from a small pension. Before your RMD, your AGI might sit comfortably under key tax or Medicare thresholds. But the minute that $23,000 hits, your income just jumped by almost 40% on paper. You didn't earn more, you didn't spend more, but the system now thinks you're wealthier. And that's what triggers the domino effect. Now, once that AGI jumps, it can spill into everything else. A higher AGI can push you into the next tax bracket, increase how much of your Social Security is taxable, and here's the quiet one, change how Medicare calculates your premiums. That's what turns a simple withdrawal into a triple hit. And here's the funny part. You could have zero need for that extra money. Let's say your living expenses are fully covered by pension and Social Security. You could have left that IRA money sitting safely, but the IRS doesn't care if you need it, they need their cut. So you end up with higher taxable income that you never asked for. Another thing most retirees don't realize, RMDs aren't isolated to one account. If you've got multiple IRAs, you can take the total amount owed from any combination of them. That flexibility helps you manage withdrawals, but it doesn't let you avoid the total. The total RMD amount still counts toward your income, no matter which account it comes from. That's why some people try to time or spread withdrawals strategically, which we'll talk about later. And here's where it gets tricky, because that rising AGI doesn't just stop at your tax return. Medicare looks back 2 years to assess your income and determine the next year's premiums. So the RMD you take at 73 affects your Medicare costs at 75. It's delayed pain, which is why so many retirees get blindsided. They see their tax bill go up this year, And then 2 years later, they get a letter saying your Medicare premiums are increasing due to higher reported income. It's like the system is punishing you twice. Let me show you how this cascade typically looks. Year 1, you start your RMDs. Your tax bill jumps a few hundred or maybe a couple $1,000s, depending on your bracket. Year 2, you adjust thinking, okay, that's the new normal. Year 3 or 4, your RMD grows as your divisor gets smaller, even if your investment value stayed flat. By then, you might have unknowingly crossed into the thresholds where up to 85% of your Social Security gets taxed. And just around the same time, Medicare reads your higher income from 2 years prior and bumps your premiums. It's slow motion creep that adds up to several $1,000s gone every year. It's also worth noting that RMDs can affect couples differently. When one spouse passes away, the surviving spouse still has to take RMDs from their own accounts, but now they file as single, which compresses their income into narrower tax brackets. So the same exact income can lead to a bigger tax bill and higher Medicare premiums, simply because you're no longer filing jointly. That's one of those deeply unfair quirks that hits widows and widowers especially hard. Let's tackle one myth. Some people think they can dodge RMDs by rolling money into a new account or ignoring them for a few years. Unfortunately, that's not how the system works. The only major account types safe from RMDs are Roth IRAs, because you already paid taxes on that money up front. Everything else, traditional IRA, SEP, simple, 401k, is subject to withdrawal rules once you're 73. Even more confusing, if you're still working and have a 401k with your current employer, you might be able to delay RMDs from that specific account, but not from any older ones. It's a loophole some people use, but it only works if you actually remain employed. So to recap what's happening here, RMDs are mandatory, they're based on your account size and age, they're taxed as regular income, and they directly raise your AGI, which then triggers other costs. The system connects these pieces in a way that punishes success. You save diligently, and now those very savings drive up your tax and healthcare expenses. It's frustrating, but it's also predictable, and once you understand the math, you can plan around it. Because once that RMD income bumps up your reportable numbers, the government's next move is automatic. Your higher AGI recalculates your Social Security tax exposure. And that's where most retirees first notice the real pain. You check the box for a routine withdrawal, and suddenly your Social Security check feels smaller. So now let's follow that chain reaction and see exactly how that second hidden tax sneaks up on you, the Social Security surprise. Hidden tax number 1, the Social Security sneak attack. Let's start with the first hidden tax that sneaks in the moment your RMD hits your income, the Social Security surprise. You know that feeling when your monthly check looks smaller than it used to, but you can't figure out why? This is usually the reason. Social Security benefits can be taxed, but the trigger isn't obvious. It depends on something called your combined income, and that number is where the RMD starts messing things up. Combined income is calculated as your adjusted gross income. That's all the income you report, including RMDs, plus any non-taxable interest, plus half of your Social Security benefits. The formula is simple, but the thresholds are brutally outdated. For single filers in 2025, if your combined income is $25,000 or less, none of your Social Security is taxable. Once it sits between $25,000 and $1 and $34,000, up to 50% of your benefits become taxable. Go over $34,000, and suddenly up to 85% of those benefits get taxed. That's right, the government can tax almost your entire Social Security check if your income crosses those lines. And here's the kicker. Those thresholds were set back in 1983. They've never been indexed for inflation. For decades later, Even middle-income retirees who thought they were safe are now paying taxes that were once aimed at the wealthy. So when you add a mandatory RMD into the mix, the odds of crossing those limits skyrocket. Let's put numbers to it. Picture a single retiree named Linda. Her Social Security gives her $30,000 a year, and she draws a modest $10,000 from a small pension. With no RMDs yet, her combined income is about $25,000, which means her benefits are safe, zero taxed. But at age 73, her first RMD shows up, $18,000. Add that in, and suddenly her combined income jumps to over $43,000. Boom, she's now in the up to 85% taxable zone. Without changing her lifestyle or spending a dime more, she's just triggered thousands in new taxes. That single forced withdrawal turned her retiree comfort into an unexpected tax bill. Here's what most people don't realize. Once that line is crossed, it's incredibly hard to go back. The taxation formula doesn't smooth out gradually. It ramps up. You can be just hundreds above a threshold and still face the higher rate on most of your benefits. So the phrase up to 85% doesn't mean it trickles in slowly. It's effectively an all-or-nothing zone for many retirees. Now, there is one small bit of good news on the 2025 horizon: a temporary senior deduction. Thanks to a new law, anyone aged 65 or older can deduct up to $6,000 from their taxable income if single, or up to $12,000 for married couples, as long as their adjusted gross income stays under $75,000 or $150,000 jointly. It's meant to soften the blow. For some retirees already near the 50% zone, that deduction might pull them back under the threshold or at least reduce the tax portion of benefits. But before you celebrate, there's a catch. That deduction phases out as income rises. For retirees with higher RMDs or larger pension payouts, it doesn't do much. In planning terms, it's a small cushion, not a full solution. Most people experiencing their first real RMD will still see their combined income climb well past $34,000. So why does this matter so much? Because Social Security taxation acts like a stealth multiplier on your tax rate. The moment you start paying tax on those benefits, your marginal rate effectively jumps higher than what's printed on the brackets. In plain English, you might think you're paying a 22% tax rate, but because each extra dollar makes more of your Social Security taxable, the real impact can be closer to 27% or even 30%. It's what tax pros call the torpedo effect. Once your income crosses a certain line, the combined hit explodes upward. And it gets worse each year you live. Why? Because Social Security benefits usually rise with annual COLA adjustments, the cost of living increase meant to keep up with inflation. A 2 or 3% boost is great, but that bump adds to your combined income. And those old thresholds haven't budged in 40 years. So you get a bigger benefit and somehow end up paying more tax on it. It's one of those frustrating thanks, but no thanks moments in retirement math. Here's where retirees often make a painful mistake. They think of their RMD as entirely separate from their benefits. My RMD is just from my IRA. My Social Security is different. The IRS does not see it that way. All those numbers funnel into one big calculation. And once that combined income spikes, the hidden tax appears. It's basically one system pretending to be three different ones. A quick mental check. If you're already collecting Social Security and you're about to start RMDs, estimate how much that withdrawal will raise your combined income. If the answer pushes you past $25,000 or $34,000. If single, you're crossing a threshold. For couples, those cutoffs are $32,000 and $44,000, just as outdated. And again, they've never been indexed for inflation. Now, maybe you're thinking, all right, but what if I don't really need my RMD money right away? Can I just reinvest it or roll it back somewhere? Sadly, once that withdrawal is made, it counts as income for tax purposes. Even if you immediately reinvest it, you can't undo the reporting. That's why this first hidden tax is such a pain. It's not about what you use the money for, it's about what the government counts it as. Let's bring this to life with another quick story. Bill and Janet, a retired couple in their late 70s, kept everything neat. 2 Social Security checks, a small pension, modest savings. They were careful and comfortable. When RMDs kicked in, they didn't think much of it. We'll just let it sit in the checking account. After the first year, their tax preparer told them their taxable Social Security portion had jumped to the maximum. 2 years later, their Medicare premiums rose, too. Why? Janet asked. We didn't make more money. The answer was simple. They didn't earn more, but the system measured them differently. And that's exactly the danger of misunderstanding these thresholds. They never tell you up front that your RMD could change how much of your Social Security is taxed. The tax preparer sees it only after the year's over. It's like walking through a door that locks behind you. What can you do about it? At this stage, the best tool is awareness. Know the numbers before the IRS does. Estimate next year's income, including your upcoming RMD, and see where that lands your combined income. If you're close to a threshold, talk with a tax professional about reducing other income sources or boosting deductions, especially while the senior deduction window is open from 2025 through 2028. Some retirees time partial Roth conversions or charitable gifts right before their RMD years to smooth out income later. The main point is to keep your eye on total income, not just what's coming from one source. Because the system treats your tax-deferred withdrawal like a pebble dropped into a pond, the ripples reach every corner of your retirement plan. First, they touch your Social Security. Then, 2 years later, they touch your Medicare. Once both are moving, it's a lot harder to calm the water. So, when you think of RMDs, don't just picture that single withdrawal. Picture everything it drags along for the ride. Higher taxable income, shrinking Social Security checks, and a tighter budget. The mechanism is tricky, but the pattern is predictable. You can see it coming if you know what to look for. And now that you do, you're one step ahead of most retirees. But we're not done yet. Because if Social Security taxation is the first domino, Medicare premiums are the second one waiting to fall. The next ripple you'll feel isn't on your tax bill, it's on your healthcare statement. And it hits 2 years after the fact. Coming up next, how your RMD today can quietly triple your Medicare costs tomorrow. Now, that's the time bomb most people never even see ticking. Hidden tax number 2, the IRMAA time bomb. Now, we're stepping into the most delayed, but most painful part of the RMD chain reaction, the Medicare premium trap known as IRMAA, that stands for Income-Related Monthly Adjustment Amount. But most people just know it as the quiet surcharge that makes their Medicare bills suddenly jump. This isn't a penalty, it's just how the system prices your coverage. But when 1 year's RMD is big enough to show up on your tax return, that new income figure gets reported to Medicare. 2 years later, Medicare says, "Looks like you're doing well, time to pay more." And without warning, the bill goes up. Consider it the financial ghost of your old tax return haunting your future healthcare budget. Here's how it works. Every fall, the Centers for Medicare and Medicaid Services set premiums for the upcoming year. They base your rate not on what you're earning now, but on the modified adjusted gross income reported 2 years ago. So your 2026 Medicare premiums are based on the 2024 tax return that reflected the RMD you took at 73 or 74. It's that 2-year look back that catches everyone off guard. You can have the perfect retirement budget mapped out for next year, only to see a surprise letter from Social Security saying your income exceeded a threshold. Your Medicare premiums will increase. Let's plug in real numbers. The projected standard Part B premium for 2026 is about $206.50 a month, roughly $2,500 a year. That's for people under the first IRMAA threshold, meaning single retirees with income under around $109,000 or couples under $218,000. Sounds high already, right? But cross that line, even by a single dollar, and Medicare adds a surcharge. Go a bit higher, and the surcharge multiplies. The next bracket for singles is roughly $109,000 to $137,000, where the premium jumps by about 40%. After that, it rises again. At $171,000, you're at roughly double the base premium. Once you pass $205,000, your Part B premium more than triples. Above $500,000, it's around 3.4 times the standard rate. It's not gradual, it's a cliff system. One step too far, and you fall into an entirely more expensive world. That means you could make a small Roth conversion, realize capital gains from a mutual fund, or have your RMD spike because markets grew and suddenly you're paying hundreds more per month for the exact same Medicare coverage. There's no upgrade, no extra benefit, just a higher bill because your reported income ticked over a federally defined line. To appreciate how serious that is, imagine this scenario. Margaret, a 75-year-old retiree with a comfortable lifestyle, has average retirement income, Social Security, a small pension, and annual RMDs around $30,000. She's right below the first IRMAA threshold. 1 year, her investments do well, pushing her IRA balance up, and the following RMD is $34,000 instead of $30,000. That extra $4,000 during tax season feels harmless. It's only about $300 in added income tax. 2 years later, Margaret gets a notice. Her Medicare Part B premium will increase by $90 a month. $90 doesn't sound like much until you multiply it. Over 12 months, that's $1,080 added cost. Over 2 years, more than $2,000 extra. All from one slightly larger withdrawal she didn't even need. That's what makes IRMAA a time bomb. You don't see or feel the explosion until long after you triggered it. What makes this even messier is that the thresholds themselves adjust annually for inflation, but the adjustments are small and sometimes unpredictable. The government indexes them, but the growth formula can cause sudden jumps that drag more people in. Think of it as a moving fence line. It's technically indexed, but it doesn't move as far as your income does, especially with rising Social Security checks and required withdrawals. So even if you carefully planned under today's limit, next year's limit might shift just enough to catch you. Another key point, IRMAA applies not only to Medicare Part B, the coverage for doctors and outpatient care, but also to Part D prescription drug coverage. Each uses the same income brackets. So if one goes up, the other probably does too. That can add another $10 to $70 per month on top of the base increase. Combined, these surcharges can cost a high-income retiree several $1,000s a year. And remember, that's after taxes. You've already paid income tax on the RMD. Now you're paying inflated premiums with what's left. Let's break down why the system feels so unfair. Medicare bases those charges on the assumption that higher income means you can afford to subsidize others. It's a sliding scale designed to keep the program solvent, but it doesn't consider where that income comes from. So a forced RMD, a one-time capital gain, or even selling a vacation home looks the same on paper as a salary raise. The system doesn't know that you didn't earn more, it simply sees numbers, which means retirees who carefully saved for decades wind up in higher brackets for doing exactly what they were told, build tax-deferred savings. Now, maybe you're thinking, well, at least I can appeal if my situation changes, right? Yes, there is an appeal process. Medicare allows you to challenge an IRMAA decision if you've had a life-changing event, like retirement, divorce, the death of a spouse, or loss of income-producing property. But general investment gains, or RMD increases, don't count. And even a successful appeal often only removes the surcharge going forward. It rarely reverses what you've already paid. So relying on appeals as a fix is like calling the fire department after the house is half gone. Here's the psychological trap. IRMA doesn't feel immediately painful like a tax bill does. Taxes show up quickly. You see the total owed and write the check. With Medicare surcharges, the increase is subtle and automatic. It hides in monthly deductions from your Social Security benefit. Many retirees don't even realize they're paying more. They just notice their deposit got smaller. So they blame inflation or healthcare costs, not realizing the bigger culprit is that old tax return. That delayed cause and effect makes it emotionally harder to link the actions you took, like taking your RMD, to the outcome you're seeing today. Let's walk through another real-feel example. A couple, Dan and Carol, earned moderate income and sat comfortably below the first IRMA bracket for years. They decided to do a one-time partial Roth conversion, thinking it would help in the future. That same year, their RMDs and investment income stacked on top. Their MAGI rose to $225,000, barely $7,000 over the limit for their filing status. That single step bumped each of them into the next bracket. Their Medicare costs went up about $70 each per month. Over 12 months, that was $1,600 more after tax dollars, all because of $7,000 in extra reported income that year. Divide that out, and they effectively paid a 23% hidden tax on top of everything else. So what can you do to avoid landing on an IRMA cliff? First, know the brackets for your filing status and watch where your income sits relative to them. If you're close, think twice before realizing extra income this year. Second, coordinate RMD withdrawals for the next few years side by side with your tax advisor and Medicare planner. The goal isn't always to minimize taxes this year. It's to flatten income across multiple years, so no single year explodes your MAGI. Third, if charitable giving is part of your life, use qualified charitable distributions, which we'll discuss later. Those donations let your IRA satisfy the RMD requirement without raising income that counts toward IRMA. Each dollar given that way is a dollar not added to your MAGI, and potentially a dollar that keeps your premiums lower 2 years down the road. There's also an emotional discipline to this. Don't treat IRMA as someone else's problem until it becomes yours. Most retirees enter Medicare paying the standard rate and assume it'll stay that way forever. They hear about surcharges, but think that's for rich people. But the income thresholds aren't reserved for the ultra-wealthy anymore. Between RMD-driven income, Social Security COLAs, and small investment gains, more upper-middle retirees cross into the first or second bracket every year. Treat those limits as real and plan with them in mind. If you want a quick benchmark, the first IRMA bracket can translate to an effective annual premium increase of around $1,100. The next bracket, closer to $2,000. The largest ones, $5,000 or more. When people hear those amounts, they realize this is no small administrative fee. It's an actual erosion of their retirement income stream. Small missteps cost big over time. So every RMD, every conversion, every distribution should trigger one question. What does this do to my 2-year-ahead Medicare income? If your RMD plus other income keeps you well under one bracket, you're fine. If it pushes you near a threshold, consider ways to offset. Maybe shift withdrawals earlier to spread out income, or use a portion for qualified charitable giving. These aren't loopholes. They're simply using the rules the way Congress wrote them, to prevent the tax cascade. And remember, once IRMA kicks in, it usually lasts at least a full year before Medicare resets it based on your next tax return. That means you live with the result for 12 months Minimum, sometimes 24. Prevention is always cheaper than reaction. Here's the takeaway. IRMAA is a stealth tax disguised as a premium adjustment. It punishes high reported income regardless of where it comes from and arrives 2 years late. But with awareness, it's entirely manageable. The earlier you map out your RMDs, the lower your odds of triggering that letter that ruins your morning coffee. Because once RMD income wakes up the IRMAA time bomb, the triple tax is complete. Your savings shrink, your checks shrink, and your monthly healthcare bill swells. Coming up, let's link all three parts together so you can see exactly how one innocent withdrawal cascades through the system and what that really means for your retirement lifestyle. How the three hidden taxes combine. Here's where everything converges. The moment those three hidden taxes stop acting like separate issues and start behaving like one massive drag on your retirement income. When you hear about RMDs, Social Security Taxation, or Medicare surcharges, individually, they sound manageable. Annoying, sure, but not catastrophic. The danger comes when all three overlap, because in real life, they always do. Each one feeds the next, amplifying the damage until you're left wondering where the money went. Let's connect the dots with a simple picture. Start with an RMD, say $25,000. That figure gets added directly to your adjusted gross income, boosting your reported income to the IRS. That's the ignition point. Instantly, you've got more taxable income, meaning a higher federal tax bill. But that same increase also inflates your combined income, the calculation that decides how much of your Social Security gets taxed. So maybe last year, none of your benefits were taxable. Now, suddenly, 85% are. What does that mean in dollars? If your annual Social Security benefit is $30,000, roughly $25,000 of it might now be taxable. Multiply that by your marginal rate, and you can easily lose $3,000 to $5,000 in additional federal tax without realizing it. That's the first ripple. The second ripple moves slower, but hits harder: your Medicare premiums. 2 years after that first RMD bump appears on your tax return, Medicare looks at your income and adjusts your premium bracket. If that one withdrawal pushed you just a few $100s past the threshold, you get a pricey surprise. A Part B premium that jumps by $90 or more per month. Multiply that across both spouses, and a single-year income spike can drain another $2,000 annually after tax. And remember, you already paid income tax on that RMD money before it qualified you for the surcharge. That's the definition of paying the same tax twice, once to the IRS, then again through Medicare. Let's make the math more tangible with an example. Meet Robert and Elaine, both 74. They live comfortably on a mix of Social Security and a small pension totaling $55,000 a year. Their IRA balances are around $800,000, which sounds secure, until RMDs step in. Their first required distribution is about $30,000. It pushes their total income to $85,000, and, like clockwork, up to 85% of their Social Security becomes taxable. The increase adds roughly $4,000 to their federal tax bill. 2 years later, Medicare reassesses them using that higher income and bumps their combined premiums by another $1,400. In practical terms, that single RMD cost them more than $5,000 in lost cash flow over 2 years. They didn't overspend. The system simply reclassified their own savings as income and taxed it 3 different ways. That's why calling it a triple tax is an exaggeration. It's cumulative pressure. First, the RMD raises your income. Then the inflated income makes your Social Security taxable. And finally, that inflated number dictates your Medicare premiums. What's cruel is how quietly it happens. You file your taxes, feel the sting immediately, but then nothing for a while. A couple of years later, the Medicare hike appears, and by then it's disconnected from its original cause. You might think premiums just went up for everyone, but the reality is your personal surcharge has been brewing since your last withdrawal. Now layer inflation onto this equation. Social Security checks rise each year from COLA adjustments, which sound great until they shove you further into those old, unindexed thresholds. Meanwhile, market growth swells your IRA balance, so your RMD percentage applies to a bigger number, making the next withdrawal even larger. The compounding means every year the taxes and surcharges eat a bigger bite. A retiree who paid 15% effective tax on total income at 73 might face 23% by 77 without spending a cent more or changing a habit. It's not lifestyle inflation, it's systemic inflation. Here's another sneaky twist. When one spouse dies, the remaining partner files taxes as a single individual. The tax brackets shrink almost in half, but the RMD obligations from both accounts often remain. That widens the hidden tax gap dramatically. A couple that comfortably lived under IRMAA thresholds can see the survivor pushed into surcharge territory the very next year. Their tax liability rises, their Medicare premiums rise, and the Social Security survivor benefit, though larger, ends up more heavily taxed. It's a harsh combination that punishes loss with higher deductions. To simplify how these interact, think of your financial life like 3 buckets pouring into one basin labeled income the government cares about. RMDs pour in first, fast and heavy. That fills the basin, raising the waterline enough to submerge your Social Security benefits, making them taxable. A higher waterline also flows straight into Medicare's calculation pool, triggering IRMAA. The government doesn't drain each bucket separately. It just measures the total depth and charges accordingly. That's why each extra dollar from RMDs creates a splash big enough to raise every other cost. Now, if we look at real-world impact across time, the numbers get sobering. Let's say you start with an RMD of $20,000. Assuming average portfolio growth and the gradually increasing withdrawal percentage, by age 83, that RMD might rise to about $35,000. Over 10 years, you'll have withdrawn roughly $300,000. Conservatively, 15 to 20% of that, $45,000 to $60,000, goes to taxes. Layer in the cumulative Social Security taxation and IRMAA surcharges, and you're easily north of $75,000 in effective hidden taxes. $75,000 over a decade could have paid for private health insurance supplements, home upgrades, or a solid travel fund. Instead, it vanishes quietly into overlapping government formulas. Psychologically, this triple impact creates confusion because retirees experience losses in fragments. The tax bill lands first with a clear number, so that feels like the only cost. Months later, the net Social Security deposit looks smaller due to withholding, but it's subtle. Then 2 years on, Medicare deductions trim the check again. The spread out timing dulls the sense of cause and effect, which is why so many people never connect the dots. They assume rising expenses or government inflation are at fault, not realizing these are self-reinforcing effects from the same RMD process. And remember, the entire pattern resets annually. Each new RMD recalculates the baseline for taxes and, down the line, premiums. That means every January, you unknowingly pull the lever on a machine that will cost you thousands by the time it completes a full cycle. Understanding that timing is what allows strategic retirees to plan ahead, because every big withdrawal today forecasts a higher Medicare bill 2 years from now, guaranteed. So, what's the emotional takeaway here? You can't stop RMDs, but you can stop being surprised by them. Awareness is your buffer. Once you view those required distributions as the ignition point for a chain reaction rather than isolated events, you start making different decisions. Smaller withdrawals earlier, tax-efficient giving, staggered Roth conversions. Each move chips away at one part of the cascade and helps flatten the overall cost curve. Here's the bottom line. The hidden tax triple threat doesn't happen because you did something wrong. It happens because the system rewards saving on the front end and recoups its share on the back. The key is recognizing how tightly connected taxes, Social Security, and Medicare really are. When you see the full picture, you stop reacting and start controlling. And that's exactly where we're headed next, into the smart, hands-on fixes that can put money back in your pocket and keep it there. Fix number 1, manage withdrawals strategically. All right, let's move from what's going wrong to what you can actually do about it. Because while RMDs are mandatory, the way you manage your total withdrawals isn't carved in stone. And this part is where strategy truly pays off. Think of this as your roadmap for turning mandatory withdrawals into predictable, manageable income instead of chaotic tax triggers. The goal isn't to dodge the system. It's to work within it, using timing and planning to keep those hidden taxes from multiplying. The first step is understanding that retirement income isn't just about how much you withdraw. It's about when and where it shows up on your tax return. Too many retirees ignore that timing until their first RMD hits, and suddenly their income spikes. You want to smooth that curve before it gets steep. This is what financial planners call income smoothing or tax bracket management. In plain talk, it means pulling smaller amounts out of your tax-deferred accounts during lower income years so that future RMDs and future taxes don't blow up your return. Here's how it works. Before you reach age 73, you might have a few years where your income is unusually low. Your job income's gone. Social Security may not have started yet, and you're living mostly on savings. Those years are golden. They're the perfect window to start drawing lightly from your IRA or 401k before the government forces you to. If you strategically take, say, $15,000 in those low-income years, you reduce the principal that later RMDs are based on. Lower balances mean lower required withdrawals down the line, and that's real money saved. Think of it like easing pressure from a dam. Letting out a bit early keeps it from bursting later. Let's play it out with a simple example. Carol retires at 67 and waits until 70 to claim Social Security. Between those years, she pulls moderate withdrawals from her IRA, while her total income sits in a comfortable low tax bracket. She uses those withdrawals to cover living costs or even to top off a savings account she'll live off later. The side effect? Her IRA balance shrinks slightly, reducing her RMD amount at 73. Because she tapped it early, she spread the tax burden over more years and crucially avoided the steep combined income effect that would have hit later. That's income smoothing in action. Now, if you've already reached RMD age and missed that early window, don't panic. There are still smart moves left. The first is coordinating your RMD timing within the year itself. You don't have to take it in January. You can spread it out monthly, quarterly, or all at once in December. Which approach works best depends on your cash flow and your tax picture. If you're near a tax threshold in early fall and see yourself getting close to a limit, you can hold off the last distribution until the following calendar years start, as long as it meets the deadline. That slight delay could keep you under a Social Security or IRMAA cutoff. Here's where bracket management meets psychology. A lot of retirees fixate on minimizing taxes in the current year, but that short-term view can backfire. A smaller tax bill this year might cause a much larger one next year if it leads to a jumpy income curve. Instead, aim for consistency. Pay a bit more now if it means staying below costly cliffs later. That mental shift, seeing taxes as something to manage over time, not just avoid once, makes every withdrawal decision smarter. Remember, smooth curves make for calmer financial waters. Married couples have an even bigger opportunity here. If both spouses are drawing income, you can split withdrawals across accounts and individuals in different ways. Say one partner has a smaller IRA balance. Having that person withdraw more can help keep the joint AGI at a safer level while still meeting combined spending needs. Couples filing jointly also enjoy wider tax brackets before IRMAA thresholds kick in. Coordinating withdrawals between spouses is often worth thousands in savings. It's all about teamwork. Two smaller withdrawals can have a lighter overall impact than one big one. And while we're on teamwork, think multi-year, not single year. Start mapping your expected income 3, 5, even 10 years out. Project when Social Security starts, how those COLA increases will stack, and how much your RMDs will grow based on the IRS life expectancy tables. If you can visualize that curve, you can design withdrawals that fill lower tax brackets before they vanish. For example, filling up the 12% tax bracket today can prevent being shoved into the 22% or 24% bracket later when RMDs and benefits combine. That's sophisticated planning. Yet it's absolutely doable with today's tax software or a certified planner's help. Let's hit on a common pitfall, the lump sum reflex. Some retirees like to take all their RMDs at once, often early in the year, because they want it out of the way. The problem is that suddenly adds a large chunk of income at one moment, making it easier to cross a threshold. Splitting that same withdrawal into monthly segments could keep your provisional income steadier and make estimated tax payments easier to handle. It's less dramatic, less likely to push you into a higher marginal zone, and easier emotionally, more like a steady paycheck than a one-time windfall that comes with a hidden cost later. Here's another advantage to spreading or managing withdrawals early. It gives you flexibility for unexpected expenses. Suppose you face a major cost, medical, home repair, a family emergency. If your RMD already boosted your income for the year, pulling more could mean double trouble on taxes and next year's Medicare premiums. But if you've planned evenly and stayed under key limits, there's cushion to handle those extra withdrawals when life happens. Strategic planning buys flexibility, the best insurance policy for peace of mind in retirement. Some folks wonder whether delaying Social Security while spending down IRA balances early is a smart move. Often, yes. Think of it this way. Delaying Social Security until 70 increases your monthly benefit significantly. Using IRA funds during those gap years not only helps bridge the income, but also trims the future RMD pool. You get stronger guaranteed income later and lower taxable withdrawals in your 70s. A double win. The trick is coordinating these timelines so you're not triggering large, overlapping income bursts in the same year. Another layer of strategy shows up when you pair withdrawals with deductible expenses. Let's say you plan a big charitable donation or have large medical expenses. Those deductions can absorb income more efficiently. If you know you'll itemize that year, withdrawing extra IRA funds may cost less in taxes. Align big withdrawals with big deductions whenever possible. That's how you make the system's math work for you instead of against you. I should mention a couple of advanced tools. Using qualified charitable distributions or Roth conversions in combination with withdrawal planning. QCDs let you send some or all of your RMD directly to charity without counting toward AGI, perfect for givers. Roth conversions, on the other hand, intentionally create taxable income now to prevent larger taxable RMDs later. These deserve their own sections, but just know they're part of the same idea. Manage income on your terms before the system does it for you. It's also crucial not to think of withdrawal planning as an annual chore. It's an ongoing conversation with yourself or your advisor. Every year brings shifts. Market gains or losses alter RMD values, COLA bumps affect your total income, and tax laws adjust brackets. Treat year-end planning as a standing appointment. A single afternoon in front of a simple spreadsheet can reveal whether your next RMD will threaten a new threshold. And if it does, a quick charitable gift, rebalancing move, or staggered distribution could fix it. One more subtle but powerful tactic: coordinate federal and state considerations together. Some states tax retirement income differently, or not at all. If you're considering a move or splitting residency, knowing those rules might change where you take withdrawals from first. For example, if your state doesn't tax IRA distributions but your new one does, it might make sense to draw more before relocating. It's another way timing protects long-term savings. At its heart, managing withdrawals strategically is about turning reaction into intention. Instead of waiting for tax bills or Medicare surcharges to surprise you, you're orchestrating your income flow each year like a conductor balancing the instruments in a symphony. And the payoff isn't just financial, it's emotional. You stop feeling at the mercy of government formulas and start knowing exactly what's coming and why. That predictability creates calm, and calm is priceless when you're living on fixed income. So as you look ahead to your next RMD season, ask yourself 3 simple questions. Can I start trimming my balance early? Can I spread this year's withdrawal to stay under key limits? And can I plan next year's income to hit a smoother line? Answering yes to even one of those means you're already breaking free from the passive pattern that traps most retirees. And once this foundation is set, you'll be ready for the next level of control, moving money to accounts that never trigger RMDs at all, where the growth stays tax-free, and the income doesn't raise your Medicare costs. That's where Roth conversions come in, and that's up next. Fix number 2, the power of Roth conversions. All right, let's talk about one of the most powerful financial moves available to retirees, the Roth conversion. This is the tool that can literally rewrite the ending of your retirement tax story. If the RMD trap is the leak in your bucket, a Roth conversion is the patch that can stop it for good. But before we get deep into strategy, let's lay out what it actually is in plain English. A Roth conversion simply means taking money from a traditional IRA or 401k, money that hasn't been taxed yet, and moving it into a Roth IRA, where it's taxed right now, but never taxed again later. Once it's inside that Roth, it grows tax-free. And best of all, Roth IRAs have no required minimum distributions. That means once you make the conversion, the IRS no longer gets to dictate when you take the money or how it counts toward your income. Sounds too easy, right? The catch, of course, is that the amount you convert counts as income in the year you do it. So if you move $50,000 from a traditional IRA to a Roth, your taxable income goes up by $50,000 that year. The trick is balancing that short-term tax cost against the long-term benefits. No future RMDs, no new Social Security tax spikes, no IRMAA surcharges decades down the line. It's like paying your tax bill once instead of every single year for the rest of your life. Here's why that's so powerful. Remember how earlier we talked about the domino effect? RMDs raising AGI, which then triggers Social Security taxation. And IRMAA, well, when you shift money into a Roth, you dismantle that domino setup. Because those future Roth withdrawals never show up in your modified adjusted gross income, MAGI, they can't trigger higher Medicare premiums or cause more of your Social Security to become taxable. You're trading one known cost now for certainty and flexibility later. That's not just smart finance, it's emotional relief. You know exactly what the price is up front, and you're free of surprises afterward. Let's break this down with a scenario. Take someone named Ron, age 65, recently retired, living mostly on savings, and not yet required to take RMDs. His income this year is modest, maybe $30,000 total between investments and part-time work. He runs a quick projection with his tax advisor and learns he can convert about $40,000 from his traditional IRA to a Roth without jumping into a higher tax bracket. So he does it paying roughly $6,000 or $7,000 in tax now. Over time, that conversion reduces his taxable IRA balance. And when RMDs hit at 73, his required withdrawal is several $1,000s smaller each year. The smaller withdrawals keep his AGI lower, his Medicare premium steady, and his Social Security taxes manageable. That single decade of small conversions can save him tens of thousands down the road. Now compare Ron's story to someone who waits too long. Same balances, same savings, but he doesn't start conversions until RMDs have already begun. The moment he takes his RMD, his AGI jumps, leaving less room in his tax bracket for any conversion. Each dollar converted stacks on top of income that's already pushing him near an IRMAA threshold. He ends up paying steep tax and facing higher Medicare premiums anyway. Timing here is everything. Doing small conversions before RMD age gives you the best control. The magic phrase is smaller, staggered conversions. Some retirees think, let's just move it all at once and be done with it. Big mistake. Converting a large sum in a single year can rocket you into multiple higher tax brackets and trigger massive IRMAA surcharges 2 years later. A smarter route is gradual, moving manageable chunks each year that keep you comfortably inside your current tax bracket. Think of it as filling your bracket to the brim, but never spilling over the edge. You pay what you expect, avoid cliffs, and steadily build your tax-free bucket. Let's make that tangible. Suppose you and your spouse file jointly, and your total income sits around $90,000 a year, solidly within the 12% bracket. You might have about $35,000 of headroom before hitting the next bracket. You could convert, say, $30,000 this year, paying around $3,500 in federal tax. Next year, you repeat. After 5 or 6 years, you've shifted over $150,000 into Roths, trimming your future RMDs by thousands per year. That's how long-term planning quietly saves you from the hidden tax chain reaction. Here's another reason conversions matter: the 2-year Medicare look back. Because IRMAA decisions rely on tax returns from 2 years earlier, any conversion you do today will affect your Medicare premiums 2 years from now. This means you can strategically time when to execute a conversion based on where you are in relation to Medicare enrollment. If you're 63 or 64, that's your sweet spot. Complete conversions before your income starts influencing your future premiums. For those already on Medicare, you can still convert, but you'll want to keep the amounts smaller so they don't catapult you across an IRMAA threshold. A huge psychological benefit here is future peace of mind. Think about how stressful tax season can feel now, wondering how much of your Social Security check will be taxed or why your Medicare premiums went up again. Roth conversions remove that guessing game. You pay the bill once, and it's done. Every dollar left in your Roth grows and can be withdrawn tax-free, no matter what laws change later. Congress can tweak brackets, IRMAA thresholds, and deductions, but they rarely touch Roth accounts because the taxes have already been collected. That gives you something increasingly rare in retirement planning: certainty. One concern people often voice is, what if I pay the tax now and then die before using it? Wouldn't that be wasted money? Not really. Roth assets are among the most inheritance-friendly tools around. Your heirs inherit tax-free growth potential, often over a 10-year period, and withdrawals for them don't count as income either. So rather than passing on a taxable time bomb, you're passing on clarity and maybe avoiding future fights with the IRS from beyond the grave. Another misunderstanding is that conversions have to happen in one lump sum or only once. Not true. You can convert portions from multiple accounts in different years or even different months if needed. You can test small amounts first to see the tax impact, then adjust. The flexibility is unmatched. For many retirees, it's also emotionally easier to swallow a smaller tax bill each year than one massive hit up front. It feels like steady progress, less shock, more control. If you're married, consider coordinating conversions with your spouse. Joint filers enjoy wider tax brackets, So the window before hitting higher rates is much larger. Doing conversions during the years you file jointly can maximize efficiency. If one spouse passes away, conversions done earlier will reduce the surviving spouse's RMD burden when their brackets narrow. It's one of those financial kindnesses that keeps paying dividends long after the tough stuff happens. Let's use a couple of micro stories to show this in action. First, Helen and George, both 66, decide to convert about $20,000 per year while George still does part-time consulting. They pay moderate taxes now, and by 73, their RMDs are half what they would have been. They stay below every IRMAA threshold. Their Medicare premiums remain stable, and their total lifetime tax outlay drops dramatically. Then there's Alicia, who delayed until 74, did one large conversion of $200,000, and unknowingly triggered not just one but two IRMAA brackets. Her Medicare premiums jumped more than $2,000 the following year. A classic too much, too fast outcome. The difference was pacing, not luck. Now, you might wonder, how do you figure out your ideal conversion amount? The easiest starting point is a simple tax projection. Look at your current AGI, subtract it from the top of your existing tax bracket, and see how much space is left. That gap is potential conversion room. If you have a financial planner or use good tax software, they can run scenarios showing what happens if you convert 5,000, 15,000, or 30,000. You'll see the immediate cost and how it affects future RMDs and IRMAA risk. Once you visualize those numbers, the strategy stops being abstract, it's just arithmetic. But let's acknowledge something human. Paying more tax voluntarily feels wrong. It's counterintuitive to spend money on purpose when you could delay it. The mindset shift lies in focusing on total lifetime tax, not single-year tax. Roth conversions give you a choice. You can pay a small, predictable bill today or wait for a growing, unpredictable one later. Most retirees, after running the math, realize that paying a bit now, while rates are historically low, beats paying a lot later when withdrawals, benefits, and inflation intertwine. And here's the emotional reward: freedom from the what-if. Once you've built up a Roth cushion, you decide when and how to spend it. Need a new roof, gifting money to grandkids, or covering medical bills? Every dollar you pull from the Roth doesn't affect your tax bracket or Medicare. That's income independence. You finally control what the government can and can't count as your income. In short, the power of Roth conversions is about converting uncertainty into control. You reduce future RMDs, sidestep the Social Security tax trap, dodge IRMAA surcharges, and build a pool of money that won't move your income needle ever again. It's a short-term sacrifice for long-term calm, a trade that most financially savvy retirees are making now while tax rates remain historically friendly. The secret isn't in doing everything at once. It's in starting early and doing it steadily. So if you're between 60 and 70 and haven't yet mapped your Roth strategy, this is the window. Every small conversion now is one less forced withdrawal later. And if you're already past 73, you can still blend conversions with techniques like charitable distributions to cap taxes and preserve your Medicare savings. Speaking of that, there's one more powerful move that helps you neutralize RMDs entirely while supporting good causes: the Qualified Charitable Distribution, or QCD. Let's dive into how that works next. Fix number 3, the Qualified Charitable Distribution, QCD, strategy. Now, let's talk about one of the most underused yet incredibly powerful tools in the retirement playbook, the Qualified Charitable Distribution, or QCD. This strategy is one of those rare win-wins hidden in the tax code. It helps you meet your RMD obligations while also helping causes you care about, and at the same time, it prevents that income from showing up where it can raise your taxes or your Medicare premiums. If you've ever thought, "I'd love to give to charity, but I can't afford to lose the tax break I used to get when I was working," this is your modern-day workaround. Here's the simple definition. A QCD lets individuals aged 70 and a half or older transfer money directly from their IRA to a qualified charity, up to $100,000 per year. That donation counts as part of your required minimum distribution for the year, but, and this is the key part, it does not count as taxable income. Because the funds go straight from the IRA to the charity, they bypass your adjusted gross income entirely. That means those dollars never inflate your AGI, never push more of your Social Security into the taxable zone, and never risk triggering IRMAA surcharges on your Medicare premiums. The government is satisfied. You've met your RMD, but you've basically sidestepped the domino effect that normally starts from that withdrawal. Let's walk through how it works in real life. Say you're 75. Your IRA requires you to take out $20,000 this year, and you typically give around $5,000 each year to your local food bank and your church. If you write a check from your checking account after taking your RMD the normal way, your entire $20,000 counts as income. You'll then claim a charitable deduction only if you itemize, which most retirees don't anymore because of the high standard deduction. So the odds are you get no real tax benefit for those donations. Now, if you instead make a QCD, tell your IRA custodian to send that $5,000 straight from your account to those charities, that amount still satisfies part of your RMD requirement. But it never lands on your tax return as income. You only report the remaining $15,000 as taxable. Just like that, you cut your AGI by $5,000 compared to doing it the old way. That could be enough to keep you under a Social Security tax threshold or an IRMAA cliff. It's elegant, simple, and absolutely IRS approved. Here's the part people often miss. QCDs only work when the money goes directly. You can't withdraw it to your checking account and then decide to donate it. The check or transfer has to be made straight from the IRA to the charity. That's what keeps it invisible to your AGI. Your custodian usually issues the check in the charity's name, sends it to you for forwarding, or mails it directly. Different firms handle it differently. But as long as that direct line is preserved, you're golden. There are a few rules to keep straight. First, you must be at least 70 and a half on the date of the distribution, not just turning that age later in the year. Second, you can give up to $100,000 per person per year, meaning a married couple could each donate that amount from separate IRAs. Third, the receiving organization must be a qualified 501(c)(3) charity. That means most churches, universities, and nonprofits count, but private foundations, donor-advised funds, or supporting organizations do not. The IRS drew that line to prevent people from indirectly donating to something they still control. Now, let's see how this looks on your tax return. Your 1099-R, the form reporting IRA distributions, will still show the full amount withdrawn from your account. But on page 1 of your tax form, you'll note how much was actually taxable. Say your distribution was $20,000 and you sent $5,000 as a QCD. Your 1099-R box might show $20,000, but you'll report $20,000 total, $15,000 taxable. That simple line saves you tax on $5,000 and could quietly protect you from multiple other dominoes. One of the best examples I've seen came from a client named Marie. She was 76 with a comfortable IRA balance and a generous heart. Every December she wrote 5-figure checks to her favorite animal shelter and local family center. The first year RMDs started, her accountant noticed her income jumped just enough to make 85% of her Social Security taxable. She was frustrated. I made the same donations I always do. The next year, we directed her IRA custodian to send QCD transfers instead of her writing personal checks. Her AGI dropped below the threshold, saving about $2,000 in taxes and a future Medicare surcharge. Nothing else changed except the route the money took. That's the magic of a QCD. It doesn't require new spending or cutting back. You're leveraging giving you likely already do. In behavioral terms, it feels emotionally rewarding because it pairs generosity with control. Every dollar given to a cause you love simultaneously shrinks the income the government uses to tax you. So you feel good twice, once for helping others and again for not overpaying Uncle Sam. Another reason QCDs shine today is the post-2017 tax landscape. Since the Tax Cuts and Jobs Act, far fewer retirees itemize deductions because the standard deduction is so high. That means traditional charitable write-offs benefit only a small percentage of older taxpayers. The QCD bypasses that issue entirely. You get the deduction effect directly through lower AGI, even if you claim the standard deduction. For anyone who gives regularly, that's arguably the cleanest, most efficient tax benefit available. You might ask, can I do a QCD from my 401k? Not directly. The rules apply only to IRAs, traditional, SEP, or simple. However, you can roll 401k funds into an IRA and then make the donation. That one-step rollover opens the door to QCD flexibility in retirement, especially for people whose old 401k now trigger RMDs. Again, it's about direction. The funds have to move straight from the eligible account to the qualified charity. Something else retirees appreciate about QCDs is the sense of active choice. Most of the hidden taxes we've talked about, Social Security Taxation, IRMAA increases, happen passively. You don't get to decide when or how they hit. With a QCD, you're back in control, using your distribution to reduce those other numbers consciously. That restores a feeling of agency, which financial psychologists say is one of the strongest indicators of satisfaction in retirement. Knowing you're steering the ship again can relieve a lot of that "I'm trapped in the system" tension that RMDs create. You can even combine QCDs with other strategies. For example, if you're still doing small Roth conversions to manage future taxes, you can use QCDs to offset the AGI bump those conversions might cause. Suppose you convert $15,000 to a Roth this year, but also make $10,000 in charitable QCD gifts. The net increase to your AGI could end up smaller than the conversion alone would have created. It's a balancing act, offsetting taxable moves with tax-free generosity. There's also a timing trick that many overlook. You don't have to wait until December to make a QCD. If you do it earlier in the year, you reduce taxable income for the full year and potentially lower estimated tax payments. For retirees who give regularly anyway, setting up quarterly QCDs works beautifully. It feels like budgeting donations on autopilot while keeping your AGI low year-round. Now, imagine the long-term impact. If you donate even $5,000 annually through QCDs for 10 years, that's $50,000 given to charity, but also $50,000 not counted toward your taxable income. If your average marginal tax plus IRMAA impact is, say, 25%, that's more than $12,500 effectively redirected from taxes to good causes. You can literally measure the difference your generosity makes both morally and financially. As retirement planning tools go, few combine math and meaning as neatly as this one. You satisfy the IRS, guard your Medicare premiums, reduce your Social Security tax risk, and fund something that matters to you. And you don't need to be wealthy. Even small recurring QCDs can shift the line enough to protect your income thresholds. $1,000 here, $2,000 there. It all chips away at taxable totals that drive hidden costs. So, if you're 70 and a half or older, ask your IRA custodian about setting up a QCD this year. It's one phone call that could save you money, simplify your taxes, and make your giving twice as impactful. For retirees who already give regularly, it's not about doing more, it's about giving smarter. Now, maybe charitable giving isn't your thing. And that's okay. There are still other levers you can pull to defend your income and neutralize those hidden taxes. The most important of them requires a bit more foresight, but pays dividends in peace of mind. It's what we call multi-year tax planning, and that's coming up next. Fix number 4, multi-year tax planning. Now we're moving from one-year reactions to long-game mastery, multi-year tax planning. This is where you stop playing defense and start running your own financial offense. The truth is, taxes in retirement don't happen in isolation. Every withdrawal, every deduction, every benefit election has ripple effects that can stretch years into the future. When you map that horizon now, you can decide exactly when to take income, how much to convert, and which thresholds to avoid. It's not about complicated accounting. It's about thinking in seasons rather than snapshots. Let's define it first. Multi-year tax planning means lining up your future income streams, RMDs, Social Security, pensions, investments, and deliberately shaping when each comes into play. Instead of waiting for April 15th to see what damage was done, you look 3, 5, even 10 years out and plan the slope of your income curve. The smoother that line, the fewer cliffs you tumble over. In practice, it's about steering your adjusted gross income into consistent, predictable lanes that stay safely under critical thresholds for taxes and Medicare. Imagine controlling the weather instead of just checking the forecast. That's what this feels like once you do it right. Here's the heart of it. Every system that penalizes retirees, income tax brackets, Social Security taxation, IRMAA, relies on specific dollar cutoffs. Those cutoffs might change a little each year, but the pattern is known. So the question becomes, do you want to find out you crossed one only after you've already paid? Or do you want to schedule your income so you never approach it in the first place? Multi-year planners choose the latter. They run tax simulations or projections that show upcoming RMD growth, expected COLA increases, and future deductions. They can then shuffle when to convert IRAs, when to harvest capital gains, or when to bunch charitable gifts to optimize those future years. Let's illustrate that with a story. Jack and Susan are both 70. They use software their advisor provided to project the next decade of income. It shows that at 73, their combined RMDs will spike them into not only a higher tax bracket, but also the first IRMAA tier 2 years later. So together they decide to draw $10,000 extra per year for the next 3 years before RMDs hit to reduce future balances. They also accelerate a small Roth conversion campaign during this period while tax brackets are still historically low. The result? Their overall taxes and premiums for the next decade come out thousands less than if they just waited. Same money, same accounts, different timeline. That timeline trick becomes especially powerful around life transitions. Many retirees face major changes, selling a home, losing a spouse, starting Social Security, or making big medical deductions. Those years often produce unusually high or low income. A multi-year plan turns those spikes into opportunities. For example, high expense years, like when long-term care costs or big medical procedures hit, create large deductions. That's a great time to take bigger withdrawals since the deductions absorb tax. Conversely, during lean years with little deductible spending, you might keep income light to preserve low brackets and avoid launching IRMAA later. Another overlooked benefit of this kind of planning is protection from future tax law changes. Current income tax rates are scheduled to sunset in 2026 unless Congress acts. That means that within 2 years, brackets could shift upward by several percentage points. Multi-year planners don't wait to see what happens. They accelerate income recognition now if it fits the strategy. Paying 12% or 22% today could be much cheaper than paying 15% or 25% tomorrow. It's not guesswork, it's hedging against math we already know. The psychological shift is also crucial. Short-term tax thinking is emotionally satisfying. Hey, I saved money this year. But it can trap you in surprise costs later. Multi-year planning trains you to measure success over a longer arc. Think of it as gliding instead of jumping. Each year's goal isn't to hit the absolute minimum tax, but to keep the lifetime tax low and predictable. That calmer curve also means fewer emotional shocks, no more random premium hikes or surprise withholding bites from your Social Security. Consistency becomes its own confidence booster. If you want to apply this practically, start by building a simple timeline. Down one side of a sheet, list ages 70 through 85. Across the top, include categories like expected IRA balance, estimated RMD, Social Security, projected deductions, and IRMAA threshold. Filling in just rough estimates shows you where future trouble spots might appear. Maybe at 78, your RMDs look huge because of strong market growth. Maybe at 81, the survivor filing change could push income into higher brackets. Seeing that pattern on paper makes solutions obvious. You might increase Roth conversions earlier or stage bigger charitable gifts right before those high-income years. Speaking of survivor filing, this is one of the saddest yet most preventable financial shocks. When a spouse dies, the survivor loses joint filing status almost immediately. The brackets cut in half, but much of the income remains. The survivor keeps the larger of the two Social Security benefits and any RMDs from personal accounts. That compresses taxable income overnight, including what-if projections for survivor years in your multi-year plan prevents traumatic surprises later. Couples who convert or withdraw strategically while both are alive can protect the surviving spouse from RMAA cliffs later. Another piece that belongs in every long-term plan is spending. Sequencing, lining up where each year's cash will come from. Year 1, maybe you pull from taxable brokerage accounts. Year 2 and 3 from traditional IRAs. By splitting sources across years, your adjusted income toggles gently instead of bouncing wildly. Every extra year, you can delay a large RMD payout while keeping retirement comfortable is another year IRMAA can't touch. Think of it as income choreography. Each move deliberate, fluid, and balanced to keep the simulation smooth. An often ignored element of multi-year planning is anticipating your own health trajectory. Medical expenses tend to rise later in retirement, and those costs often become deductible when they exceed 7.5% of adjusted gross income. Planning to take additional taxable income in those high medical years makes financial sense. You'll offset much of the tax with deductions. If you know you'll need expensive dental implants or surgeries around age 78, bunching larger withdrawals then could net out nearly tax neutral. You're using the system's own formula to your advantage. Let's also address professional guidance. Multi-year planning can sound complex, but with the right tools, it becomes straightforward. Many financial planners now use integrated tax and Medicare calculators that model scenarios instantly. Even low-cost online programs can project RMDs and IRMAA brackets into the 203s. Paying a planner for a few hours of modeling often costs less than the first year of IRMAA surcharges it helps you avoid. The emotional return, knowing you've already anticipated each threshold, is huge. Of course, the human element matters too. Sometimes retirees get paralyzed by analysis fatigue. So many projections, so many what-ifs. Don't let perfect be the enemy of progress. The goal isn't predicting every possible future. It's setting flexible guardrails. Update the plan yearly. Tweak withdrawals or conversions slightly. Multi-year planning isn't one grand design carved in stone. It's a living blueprint you adjust as life happens. You'll feel immediate relief once you realize that minor annual tweaks prevent major future shocks. Let's put emotional benefits front and center. When you've mapped multiple years, you stop reacting with fear every time Congress changes something. You can glance at your chart and think, I already have 3 options: reduce withdrawals, shift to Roth, or gift through QCDs. That sense of readiness eliminates the dread that so often overshadows retirement finances. Studies show that retirees who engage in multi-year planning consistently report higher satisfaction with their money. And it's not because they earn more, but because they understand it better. Here's a little mini exercise you can do right after watching this. Grab last year's tax return and look at 2 numbers: your adjusted gross income and your total taxable income. Add in your expected RMD for this year. Then, check the current IRMAA bracket list. If that new total brings you within $5,000 of a threshold, you've got work to do. Maybe move some charitable giving into this year. Maybe postpone capital gains to next. Those micro adjustments compound the same way interest does. Over a decade, they can save tens of thousands and, more importantly, keep your benefits stable. Multi-year tax planning also dovetails beautifully with estate goals. Planning withdrawals and conversions across years lets you reduce future taxable balances your heirs would otherwise inherit and pay accelerated taxes on. Coordinating long-range strategies with your legacy intentions ties every piece together. You're not just saving yourself money, you're simplifying life for your loved ones too. It's efficient kindness. So when you hear multi-year tax planning, don't picture spreadsheets and sleepless nights. Picture relaxed mornings where you already know what's coming because you set it in motion intentionally. The system still plays by its rules, but you've learned the rhythm. By orchestrating income across years, instead of reacting month by month, you gain back what retirees lose most quickly: control and calm. The math matters, sure, but the real win is emotional peace. And once you've got that, the last piece is simply optimizing the order of your withdrawals, turning planning into lasting independence. That's the next move on this roadmap. Fix number 5, smart withdrawal order. We've covered timing, conversions, and long-range planning, but now we hit the question that ties them all together. When you pull money out, which account should you touch first? Because the order you choose, the sequence of withdrawals, can make or break how long your money lasts and how much the government quietly reclaims each year. Think of this as the choreography of your income streams. Everything you do affects how visible your income appears to the IRS and Medicare, and the order of withdrawals determines that spotlight. Let's start simple. Retirement accounts fall into 3 broad buckets: taxable, tax-deferred, and tax-free. Taxable accounts are your regular brokerage accounts, investments you've already paid tax on, where interest, dividends, and capital gains appear each year. Tax-deferred accounts are your traditional IRAs for a 1K-S or 403-B-S, money that hasn't been taxed yet. Tax-free accounts are your Roth IRAs, already taxed and free of future income tax and RMD requirements. Managing withdrawals among these in the right order can minimize tax bites, preserve Medicare savings, and extend portfolio life by years. The general rule of thumb for many retirees is spend taxable first, then tax-deferred, and leave tax-free for last. Here's why it works. Pulling from taxable accounts early uses money that's already been taxed, while letting tax-deferred money continue compounding. This also keeps your adjusted gross income lower, delaying the moment RMDs and Social Security Taxation start stacking together. As those taxable accounts shrink, the income they generate, like dividends or capital gains, drops too, keeping your AGI leaner in future years. That's a quiet IRMA shield in disguise. Now, let's see this in action. Say you're between 67 and 72, retired but not yet subject to RMDs. Using your taxable brokerage savings to cover living expenses makes sense during these years. You pay limited capital gains, your overall income stays moderate, and you can even do small Roth conversions at attractive tax rates. You're essentially clearing the taxable brush so tax-deferred growth can shine later. Then, once RMDs begin, you shift to drawing from those accounts. The order reverses naturally as the IRS forces withdrawals. Meanwhile, your Roth accounts stay untouched, quietly compounding tax-free for future flexibility. This sequence doesn't just save taxes, it adds predictability. By burning down the taxable accounts first, you reduce the complexity of quarterly estimated payments and volatile gains. Your tax return becomes cleaner because your AGI isn't inflated by constant distribution activity. When Medicare reviews your income later, what they see is a smooth, modest pattern, not roller coaster spikes, and that can save hundreds per month in premiums. Let's take a real example. Emily, 74, starts the year with a small brokerage account balance and a sizable IRA. Instead of drawing her entire RMD early, she sells appreciated investments from her brokerage for cash flow until mid-year. Doing that triggers some capital gains, but because her total income remains below the 15% capital gains bracket, they're taxed lightly, almost free. Later in the year, she takes the minimal RMD to meet the IRS rule. Her Medicare premiums stay flat, her Social Security taxation barely budges, and she ends the year with breathing room. If Emily had reversed the order, pulling her IRA first, the entire withdrawal would have inflated her AGI and pushed everything else up the ladder. Here's another hidden benefit. Keeping Roth money for last creates a safety valve for emergencies or big dreams without the penalty of higher reported income. If an unexpected medical bill arrives, or you decide on a family vacation splurge, withdrawing from the Roth won't change your Medicare bracket or make your Social Security more taxable. It's pure, untouchable liquidity. Behavioral finance studies show retirees with a dedicated, tax-free bucket spend more confidently. They feel safer knowing a surprise expense won't ignite another hidden tax ripple. That calm increases life satisfaction even more than the money saved. But this isn't one size fits all. Sometimes it's smarter to adjust the order temporarily. For instance, if investment markets drop sharply, selling appreciated assets from a taxable account might feel ill-timed. Instead, drawing lightly from tax-deferred funds that year can preserve market value. Coordinating withdrawals with market conditions can enhance both emotional comfort and long-term return. Another flexible variant flips the order briefly before large deductions. Say you know you'll have significant medical costs next year. Taking bigger IRA withdrawals during that deduction-heavy year takes advantage of tax offsets. It's a dance, not a rigid rulebook. Couples can amplify these benefits by staggering withdrawals between spouses. Suppose one spouse delays Social Security to gain a higher future benefit, while the other already draws it. The non-claiming spouse can use their IRA strategically to fund expenses, keeping the household AGI balanced across years. Then, once both are claiming benefits, they can taper IRA use and lean on taxable money again. Coordinated withdrawals transform two separate tax puzzles into one harmonized plan, and fewer IRMAA surprises later. Now, let's hit on a subtle pitfall: sequence of returns risk. Early year market losses can hurt portfolios if you withdraw from declining assets. The smartest order also considers where each withdrawal comes from within an account. Prioritize selling holdings that have appreciated minimally or generate little income tax impact. Rebalancing from high-performing assets into cash each year pre-funds upcoming withdrawals without locking in large tax events. That way, market swings become background noise instead of financial stress. Another tactic intertwined with smart withdrawal order is maintaining a short-term spending buffer, say 1 to 2 years of expenses, in cash or short bonds. This buffer means you can always choose which account to tap based on that year's thresholds or market behavior. If you discover your RMD pushes you dangerously near an IRMAA cliff, you can draw intermediate cash instead of stacking income sources. It's like an escape hatch for your tax plan. You can think of this whole approach like turning down the volume knobs on different income channels. Each knob, taxable, tax-deferred, tax-free, affects how loudly the government hears your money. Turning down the noisy ones first keeps the system calm. Letting the quiet Roth channel play last gives you control of the soundtrack. Over time, that arrangement keeps your effective tax and Medicare burden far lower than neighbors with similar savings but chaotic sequencing. Here's a quick summary formula many planners use. Taxable, tax-deferred, tax-free, but modified annually for your thresholds and deductions. Early retirement, emphasize taxable withdrawals. RMD age, comply while capping AGI. Post-RMD, late years, use Roth assets for flexibility, following that rhythm achieves the elusive trifecta: lower taxes, steady premiums, and psychological ease. Even small yearly reviews matter. Shift just 2,000 or 3,000 between buckets to fine-tune. The difference may feel minor, but over a decade, those tweaks can mean keeping tens of thousands inside your pocket instead of watching it vanish in incremental taxes and surcharges. Smart order compounds like interest, it quietly multiplies savings. Most importantly, remember this: the best withdrawal order isn't about squeezing every dime from the spreadsheets. It's about creating stability. When you understand which accounts to drain first, you stop tiptoeing through financial landmines. You wake up knowing your paychecks, your taxes, and your Medicare costs are already coordinated. That's the real definition of retirement freedom, earning peace of mind through planning. So as you finish building your strategy, timing withdrawals, scheduling conversions, mapping multi-year plans, lock in your withdrawal order. It's your final layer of defense against the hidden tax chain. When the system checks your income, it'll find exactly what you want it to see: controlled, quiet, and sustainable. And that leads perfectly to our closing thought: protecting your retirement income starting right now before the next RMD season begins. Protect your retirement income starting now. So here's the truth. You can't make the IRS erase required minimum distributions, but you can stop those withdrawals from snowballing into extra taxes and sky-high Medicare bills. The triple trap we've walked through: income tax on the RMD itself, the Social Security sneak attack, and the IRMAA time bomb doesn't have to define your retirement. Understanding it already puts you miles ahead of most people. The system counts on confusion and delay. Clarity and timing are how you turn the tables. First, make awareness your habit. Before each year begins, estimate your total income with your next RMD included. See where it lands on the Social Security and IRMAA charts. That 10-minute checkup gives you the power to act early. Maybe shift a withdrawal, donate through a QCD, or reposition funds to a Roth. These tiny, proactive moves form a shield around your future paychecks. Every dollar you redirect before it's taxed protects more of your freedom later. Next, remember that control beats reaction. The retirees who stay financially calm aren't the ones who guess less. They plan more. They treat each withdrawal as a lever, not a surprise. They map income over several years, spread conversions steadily, and plan gifts directly from their IRAs. Instead of accidentally crossing thresholds, they slide safely under them. Each careful decision compounds like interest, not flashy, but incredibly effective. You don't need perfect timing, just consistent awareness. Now, here's a mindset shift that changes everything. Think of taxes as a lifelong subscription, not a one-time bill. Every year, the government wants a renewal fee. You can't cancel the subscription, but you can negotiate the rate. Knowing how these systems link, RMDs feeding income taxes, which feed Social Security taxation, which feed Medicare surcharges, lets you negotiate wisely. You'll never overpay because of ignorance again. That's the real victory. For peace of mind, make an annual retirement audit. Check account balances. expected RMDs, projected COLA increases, and next year's IRMAA thresholds. Ask one question: what can I adjust this year to keep my income curve smooth? Maybe that means small Roth conversions, using QCDs for your holiday donations, or timing withdrawals during high deduction years. The habit takes less time than a haircut and could save you thousands. Don't overlook emotional balance either. When you know what's coming, you stop dreading the mailbox or the Medicare letter. You start treating your money like a coordinated system rather than scattered parts. Confidence replaces confusion. That alone adds quality of life. Retirement should feel like a chapter of choice, not constant financial juggling. And if all this still feels technical, that's okay. Partner with a qualified financial planner or tax professional who understands retirement income integration. Paying a few $100s for advice that saves thousands every year is a bargain, not a cost. More importantly, it relieves the mental load of decoding government acronyms every spring. Let the professionals crunch. You enjoy the calm. Remember why this matters. You spent decades building that nest egg, working long hours, watching markets, skipping little luxuries, so the future version of you could have freedom. Don't hand pieces of that freedom back out of habit. These hidden taxes aren't punishment for success. They're challenges that reward preparation. A few smart tweaks: timing withdrawals, planning a QCD, examining multi-year income slopes can protect a lifetime of effort. Ultimately, every strategy in this series distills down to one simple truth: the earlier you plan, the more choices you keep. Early control means future freedom, freedom to travel, to help kids and grandkids, or to simply breathe easier when health costs rise. You deserve that comfort. So starting today, pull out your account statements, look up your expected RMD, and sketch your next 5 years of income. Make one concrete adjustment before the next tax season. That's all it takes to start turning the hidden tax trap into predictable, controlled cash flow. Because you worked for this money, it should finally work for you, not the other way around. If this breakdown helped illuminate the hidden traps behind RMDs, share it with a friend who's about to hit 73. They'll thank you when their Medicare stays where it belongs. And if you want more step-by-step lessons on keeping your retirement income protected, hit subscribe now. Smart, simple moves like these aren't just math. They're peace of mind earned through wisdom.